Okay, so now that I've bought Goodpack and I'm risking 2% of my capital, can I buy shares of another company? Sure, I can. So for example, I look at a company called Yahoo, and I'm seeing that Yahoo is in a consolidation pattern or going sideways, and the price just broke out of the consolidation, as you can see. In fact, one of my techniques that I teach in Wealth Academy is we buy when the price breaks out of a consolidation into a new uptrend. And you can see the 50 is again above the 150, so that's a perfect time to buy to ride the new uptrend. So I'm going to buy it there at $17. So once again, I have to put a stop loss in case I'm wrong and the price comes down and it fails, right? So I'm going to put a stop loss at $15.50, which is just below the previous low over there. Now, I'm going to put a profit target at $22. Okay? Now, in this case, I calculated the intrinsic value of Yahoo and found that the share is worth $22. So, in other words, the price should go to at least $22. I mean, it can go higher, but at least $22. That is my target price. So, what is my risk per share? So, $17 minus $15.50 is $1.50. So, the worst that can happen is I lose $1.50 for every share I buy, right? Now, if the price goes to my profit target of $22, I can potentially make $5 per share, which is 22 minus 17. So again, I'm risking $1.50 to make $5. What's my risk to return ratio? It's 1:3. So again, as long as it's at least 1:2, I'm taking the investment. Great. So for Yahoo, how many shares do I buy? Well, I use the same calculator or the same formula, if you will, right? So same thing, I take my risk per trade, which is 2%. I always fix at 2%, multiplied by my capital. What's the existing capital? And again, that's $200. So when I bought Goodpack, I was willing to risk $200. When I buy Yahoo, I risk another $200. So I always risk the same percentage of my capital. Okay? But in this case, each share, I'm risking $1.50. So I take $200, divide by $1.50, I get 133 shares. So for Yahoo, I buy 133 shares of Yahoo. So this is what it looks like. So notice that for Goodpack and Yahoo, although I buy different number of shares, but my risk must always be the same. But for Yahoo, if it hits my profit target, I make 3 times my risk, which is 6%. So notice the risk is always the same, but the return is different depending on that particular stock. Some stocks have the potential to go higher, but it must be at least 1:2. In other words, your return has to be at least 4% for you to take that investment. Now, after I invest in Yahoo, can I invest in another stock? Sure. So I invest in, say, OSIM, and I invest in Apple. So I have got 4 positions, and my total cumulative risk is altogether 8%. All right? So in other words, if all 4 of them fail, I lose 8% of my capital. I can live with that. But if all 4 of them hit their profit target, I make 12% plus 6% plus 4% plus 4%. That's a pretty good return. But of course, in reality, we may not win all our investments or lose all our investments. It's a law of probability. So we aim to be right more than half the time. So the question is this: no matter how good an investor you are, no matter how much research you do, can you be right all the time? Can every investment be a winning investment? Of course not. Let's be real. Okay? So if we can't be right all the time, what is the secret of making consistent profits every single year in the stock market, which is what I do and my students do? The secret is to think statistically and to think in terms of probabilities. My suggestion is, as an investor or trader in the medium to long term, you should do about roughly 4 trades a month. Of course, in my professional trading course, we do up to about 30 trades a month. But if you're not a professional, you can do about 4 trades a month. If you do 4 trades a month, in a year, that's 48 trades in total, right? Now, let's assume that you have a win rate of 70%. In other words, out of 10 stocks you buy, 7 you win and 3 you lose. So statistically, you see that you have 33 winning trades and 15 losing trades. Now, each time you lose 2%. Remember that? Because of our stop loss. We never lose more than 2%. So there'll be a total loss of 30% of our capital. But at the same time, for each of the wins, we will make at least 4%. Now, you saw just now, sometimes we make more than double. We can make triple. But let's assume conservatively, we only make 2 times our risk, which is 4% return when we're right. So 33 times 4 is 132%. So in other words, 132% minus 30% is 102% return on our capital. In other words, if you can be right 70% of the time, you can double your money every single year. All right? Now, it is very achievable, but it is not easy. I can tell you that it is not easy. Not many investors can do this, only if you're very experienced. So to be more conservative, I would say aim for a 60% win rate. In other words, out of 10 investments, expect to win 6 and lose 4, which fail. Okay? So at a 60% win rate, you find that that's 29 wins out of 48 trades a year, and that's 19 losses. Again, 19 losses of 2% per loss is minus 38%. 29 wins at 4% return per win is 116%. Your total return is 78% return a year. That's with a 60% win rate. Now that's more achievable. But you say, okay, what if I'm only right half the time, right? It's like I flip a coin, right? Half the time I'm right. Okay, now take a look. If your win rate is only 50%, in other words, out of 10 investments, you only win 5 and you lose 5, you have 24 wins and 24 losses. There's a total loss of 48% and a total win of 96%. And you still are able to achieve a 48% return on your capital every single year. Why? So, notice the secret is not the win rate. Even if you're right half the time, you're still making really good returns. Why? Because the secret is ensuring your average win, which is 4%, is more than your average loss. That's the most important thing in investing. Now, what if you really suck? Or you got a string of bad luck, and you didn't follow the rules well, and you're only right 40% of the time? So in other words, again, out of 10 investments, you're wrong 6 out of 10. So you get 19 wins and 29 losses in a year. But guess what? Because you only lose 2% and because you make 4% on a win, you still make a profit of 18% a year. So even if you suck, even if you're right only 40%, you're still making 18% return a year. That's pretty good. Okay? In fact, based on this system, even if you're right 35% of the time, 35% of the time, you are still making money. And that's the beauty of this system. And that's why all my students, I wouldn't say all of them, but majority of them who follow the rules of what I teach are able to make money consistently every single year. So this is Adam Khoo on the 4 keys to profitable investing. I hope you've learned something and you can subscribe to the channel if you want to learn a lot more. Take care. Happy investing.